White House reporter Hans Nichols just told us about the president's plan to rein in oil subsidies. But our next guest says that change will mean higher gas prices for Americans already facing sticker shock at the pump. Tom Petrie is a vice chairman at Bank of America, a top deal maker in the energy sector, and he joins us live from Denver this morning. So, Tom, explain to me how that works. Why would higher taxes on profits at oil companies cause consumers to pay more?
Basically, it is going to impact returns. The argument is that oil prices are so high that the returns don't matter. But in point of fact, we are getting demand destruction. We're likely to see some of that retreat that your prior commentator mentioned. And we'll get into a zone, I suspect, where if these kind of tax changes are made, they will ultimately be passed through to consumers. Will it be immediate? Probably not. But, you know, there are a number of different types of subsidies we're talking about. The one that's the most dubious in my mind is the ethanol blending credit. That one has clearly been overdone by politicians in Congress who come from corn states, and it's had adverse effects not only on gasoline but also on food.
So you wouldn't mind that particular one being changed?
I think from a policy standpoint, it really needs to be seriously reexamined.
Okay.
We've seen that one several different times be boosted with very little justification.
Now, for the oil industry itself outright, they have manufacturing credits. They've got a number of financial incentives that already exist. When you talk about changing some of those loopholes, you know, the administration would say we're not hiking taxes, we're just changing policy. How would that, though, push up the price if there isn't demand destruction? I mean, would oil companies stop pumping as much oil? Would they not invest in production in the same way?
It would have some impact about how they allocate their capital spending. And let's take two or three of the categories. There's an enhanced oil recovery benefit, and that one, if it's phased out, involves probably an acceleration in the decline of the existing base of production. Obviously, that, all other things being equal, that tightens the supply-demand picture. Another one involves the expensing of intangible drilling costs. That is, if you take away that benefit, and it's a real benefit, it's going to boost finding and development costs and rates of return, and it's probably going to cause more drilling elsewhere in the world, which probably is detrimental from an economic standpoint because it means we're more import dependent. Each of these have their own attributes, but in general, it's fair to say that there's no free lunch here. Most of the benefits that are here have been embedded in the system and are part of the rates of return that are being looked for.
Now, the administration wants to repeal these subsidies. There are $46 billion of them over 10 years' time. I mean, if they're phased out, wouldn't that lessen the chance of sticker shock for consumers?
It might have some benefit that way if it's feathered out, as you say. Time will tell. I think the other issue that has been brought up in the proposals from the administration is the idea of taking some of these benefits and then reallocating them to sustainable or green energy.
Yeah.
And I think that's a debatable proposition as well.
What is all of this doing to deal making? I mean, is it injecting a form of uncertainty that we're going to see, you know, energy companies freeze deals for a while?
No, I don't think it'll have that effect. It does get built into the prices paid and what prices transactions clear at. I don't think at this point, it's not real clear that this is other than political posturing. That was brought up by your prior speaker, and I agree with that. I think this is an easy PR play at this particular time. Whether it'll turn out in Congress to be as comprehensive as might be suggested by today's headlines remains to be seen. Let's remember the law of unintended consequences is alive and well. Anything they do in this area is likely to have adverse effects. The one I think about most yes, oil prices are high, but natural gas prices are low. The same rules apply to gas versus oil, and so you have an adverse impact on gas supply demand at a time when the gas picture was looking better.
Interesting point. So how do you characterize your forward look on gas prices? I mean, you agree with the Fed chairman, the price at the pump, the spike, transitory?
Well, it may well be. It depends on your definition of transitory. We're in the early seasonal period where seasonal demand is going to build from now until at least the 4th of July holiday. Then his comment about the third quarter, the last 2 months of the third quarter, typically gasoline prices come off, but they're coming off from a much higher level. So I'd be a little careful about relying too much on the transitory call. You know, the most important thing may be what happens with in Libya with Gaddafi in the aftermath of what happened with Osama bin Laden. Maybe there's a change coming there too.
We'll have to stay in touch with you, Tom, and track that as well. Thanks so much for joining us.